August 3, 2015. Real Estate Capital Scoreboard August 2015. Chicago, Illinois, August 3, 2015. To date, real estate investors enjoy low rates thanks to a global crisis merry-go-round with China, Ukraine, Russia, Greece and now Iran, creating cycles of market panic and driving investors back to the safe haven of U.S. Treasuries. And money never sleeps as interest rates are trending upward this year, although at a calmer pace. Benchmark yields: good news for lenders' sources, bad news for borrowers. The Fed has not raised long-term rates for nearly a decade, but the low-rate party may be about to end. In the past month, the 5-year and 10-year Treasuries fluctuated about a quarter point, landing towards the lower end of the range of about 1.5% and 2.2%, respectively. Current rates are in line with the end of 2014, still reasonably low in comparison to the past few years. Mortgage spreads: more good news for lenders. Permanent lenders exceed funding targets as worried borrowers flock to fixed-rate debt in anticipation of a Fed rate hike. Since permanent lenders are processing pent-up demand, spreads are likely to rise, many funding sources choosing to provide less leverage rather than raise spreads to remain competitive. Higher quality loans garner the most attention with LifeCos and conduits, while more risky deals are left to public/private debt funds, which are more prevalent. Banks rely on more recourse, but will offer highly competitive spreads for floating rate and short-term debt. Funding structures: Take Me to the Bridge is a popular realty finance outcry, as multiple players jump into the structured finance funding spectrum. Many of today's bridge players need to supplement their mezz, preferred equity and joint venture programs with a wider variety of options to catch deals earlier in the funding cycle. With barely any profits in conventional debt business based upon interest rates of 3.5% to 5%, debt funds entertain more entrepreneurial prospects, including partially leased and limited construction projects. Structures typically priced at combined rates of 5% to 7% over a 5-year or less holding period. Higher risk pricing approaches double-digit returns, often hovering below equity yields. The Real Estate Capital Institute's director, Gene Peck, predicts Fed rate hike discussions will spook owners into action, both for sale and financing. Look for busy money as the theme for this fall, when investors return from summer vacations to buckle down on their capital needs.